Okay, so welcome everybody to this Ascension Training Masterclass on understanding cash flows. So I am very, very pleased to have a good friend of mine, Thanasis Karagiannis, who is the Chief Investment Officer of Prodea here. So Thanasis is the Chief Investment Officer of a REIT, and he is busy beavering away in the market, a lot of which in Southern Europe, based out of Athens, doing some very interesting deals. And it's fine to listen to me and watch a lot of content about how you do this and how you build the skills to do that, and that's what we do. But I think it's another thing to hear from Thanasis firsthand, how he looks at a deal, how he thinks about cash flows, how they think about investments, and then you can open that up to any questions you like. So a couple of things to bear in mind from the outset. One is it's much better, much more engaging for Thanasis, and you'll get a better quality experience if you're happy to be on camera. So if you're willing to turn on your cameras, that makes a big difference to the people that are presenting. You can build a bit of a relationship along the way. And secondly, try to keep it on mute, but come off mute, ask questions. You know, Thanasis probably has a similar philosophy, but if you ask questions whilst people are kind of talking, it's actually really nice. It's really nice to engage back and forth and get into detail on things, and everyone benefits. So if you've got questions, go ahead and ask them. Come off camera if you can, generally, because it makes it much more enjoyable experience for everybody. And I'm going to hand over to Thanasis.
Thanks, Phil, and hi, everyone. It's a pleasure to be with you, doing that from Athens. So when Phil invited me to do this workshop with you and this masterclass, as he likes to call it, I tried to put together a small structure in how we approach it. And we were going to discuss today about cash flows. But as Phil mentioned, I would very much like that we do that as interactive as possible. So I have a few thoughts to go through with you. But at any point you want to stop me, let's do that and jump on things that you might have in mind. So the essence from today's or tonight's, depending on which time zone you are, session is to understand a little bit how I would go about a cash flow, how I would start by getting the first information from an investment, then start working through that, and then expanding that into a full-blown model. And then after doing that, checking if the model works, and if it doesn't, what do I need to do to make it work? So with that, Phil, I think I need to be able to also share the screen. I don't know if I need to become a host or something.
Give me a sec. Aha. Who can share? All participants. Boom. So I'm not a boomer. I should know how to do this. Try that. Well, I acted it like
the screen. Yeah, it's fine. It's perfect. It's perfect. It's perfect. So can I just ask if, first of all, we have a chat, right? Yes, we do have a chat. Perfect. So one thing we can do, if you guys just want to throw something and not interrupt at that point, feel free to use the chat. Otherwise, feel free to just raise your hand or whatever, just jump into the mix and say what you want. I just want to understand the level that we are all in, the background. So is everyone here studying real estate, or are you working in real estate? Just to make sure I kind of adjust the level accordingly. So the people on the screen, you're doing real estate, you're studying real estate? Perfect. Okay. Retired and investing. Wow, Paul, great. Good job. That's my dream. That's my dream as well. So I hope I can help you with that. So let me start by sharing a whiteboard, a very simple Microsoft whiteboard, and tell you the following. So let's say that someone is talking to me about a portfolio of 5-6 assets that have a total of 26,000 square meters of areas. And let's say that for simplicity, they tell me, look, this one has a passing rent of 5.3 million, which if you try to find how much that is per square meter, basically and again, this is a very simple example, is 200 euros per square meter per annum. Okay, so that's the first thing I get to know about the deal. And then I'm asking, okay, do you know how much they might be willing to sell it for? And they might tell me, so by the way, that's 5.5. So they might tell me, yeah, they want actually 100 million for that. So does everyone know how to calculate the yield for that? Who can throw on the chat? What would be the yield for that? Chat. Or before you calculate that just how would you go about calculating that? Income divided by purchase price. Perfect. Thank you, Chad. So that would be 5.5 divided by 100. So if I run the numbers, let's say it's around 5.5% yield. Okay. The next thing I would do, and assuming I know the area and more or less the office market of that place, is I would go and try to understand whether this asset is under rented or over rented. So, or maybe it's rented at market level. So what we do at Prodea, being a property company, our job is simply to acquire buildings, receive the rents, and pay them as dividend, and pay our expenses, and then the profit we distribute it as dividends to our investors. So for us, it's very important to understand what's the actual cash coming from this asset, what is the yield from this asset, and whether there is something we can do with this asset in order to improve the yield. So in that case, I would just go and try to understand the market. And let's say, for argument's sake, that I speak to my commercial team, the guys that I have over here sitting and running around the market, trying to find tenants, discussing with brokers, and trying to give me the best feeling of the market possible. And they come back and say, look, you know what? Given the deals that happen nearby, and because this portfolio of assets is actually very good, and it's brand new, it's environmentally friendly or whatever, I would say that the market rent is actually 280 euros per square meter. Okay, and that would give me the first kind of hint of where this investment is going and whether actually it's going to be a good or bad investment. So what is this guy telling me? He's telling me that this asset is under rented. The fact that the passing rent is at 200 euros per square meter and the market is at 280 euros per square meter per annum means that there is a potential to actually get more money with the same asset. So that's one tick. Now I know that there is potential money to be made here and something nice to happen. Okay. The next thing I will start asking is, okay, when are these leases expiring? And I will start going through the tenancy schedule to understand when these leases are expiring. In our example, the 280 euro per square meter will probably give me a 7.4 million annual rent, which is close to 38% increase in the rents. So if I sold this asset, let's say that I ran out the leases, I'm relating the areas, or I am actually regearing the leases with the existing tenants, but now that they come and say, look, you know what, I want to stay longer, then I go back and say, yeah, I know, but you know what, you were paying too little, now you need to pay market rents, so I need to increase your rent. And let's say all this work has happened over the course of the next 3-4 years, and now I have a building that brings me 7.4 million of rents. If I sell it at the same yield, who could tell me how much more money can I make?
It's a good question. It's actually a much more simple question than it seems.
Thank you, Chad. Anyone else? Who's going to give it a go? 48. Carol, why are you saying 48?
So I divided 7.4 by the same yield, which was, oh no, it was 5.5%.
Yeah.
So 134 million then?
Yes.
So the same as chat.
Okay. So you're changing your answer basically.
Yes.
Maybe you dropped the
I thought the yield was 5% instead of
Maybe you did the
5.
5% yield. Okay. So you did 20 times basically. All right. So that would be, yeah, 148 million indeed. Okay. So yes, I would make 38% profit. So now I have the information to start getting interested, right? Now I really want to dive deeper into this asset and try to understand more, and I try to understand whether there is a trick.
Thanasis, can I just interrupt there and ask? So if you're looking at this building and you think that there's a 38% uplift, why is that interesting to you?
This is very, thanks, Phil. Very good question. This is interesting because assuming that the market yields do not change, I can take advantage of the market circumstances in the rental market and improve the value of the building and actually sell it for a higher amount of money.
And how over what period do you, when you're thinking about underwriting, so you're thinking about doing this, getting this 40% up, I'm just gonna round it to 40% if that's all right. If you're thinking about that 40% uplift, what period are you thinking that's happening over? What do you need that to happen over?
In our case, we would ideally want that to happen in a period of 2 to 3 years. Okay. Because you wanna buy an asset that the moment you come in, there is some time left so that you can have enough time that while the rent is running, you have enough time to figure out the building and make sure you haven't missed anything on the building itself and create some promotional material and stuff like that. So you want a couple of years, a year ideally, to keep to have the yields running, to the rents running, but you don't want that to be too far in the future, because then this reversionary yield will take too long to materialize. It means that you would need to hold it for too long before you can materialize this uplift. So if I could buy it at a very attractive yield day one and also buy it under rented, I would love it, and I would not mind if the reversion would happen much later because I'm still at a very attractive yield. But if I wanted to achieve a 6.5% yield, so I'm entering at 5.5 yield. The question is, how long is it going to take me for 5.5 to become 7.4 as the tenants leave and new tenants are coming, or as the old leases are expiring and new leases are being signed? So the 5.5 becomes 6, becomes 6.5, 6.75, and at some point becomes 7 until it becomes 7.4. So that takes a little bit of time. If I can do that sooner rather than later, it's great. So the sooner I can get, let's say 675 on 100 million, that's 6.75 yield, right? So if I can do that in 2 years, then great. I can wait another 2-3 years for the remaining leases to expire and do the regearing. In the meantime, I'm actually improving my running yield. And then in order to test that assumption, I would go and start running a model. Any questions so far?
Can we just do the maths for a second on that? Because that's very interesting. So if we think there's a 40% uplift in the value of the property, and we were to get that over a 5-year hold, over 5 years, that's basically like 8% IRR a year, something like that, if we do it simply, coming off of just the uplift in capital value. Plus you've got your, what's going to be weighted average 6.5% yield income. Yes. So you're basically getting the 8% IRR plus the 6.5% IRR per annum. So you're getting a 14.5 IRR unlevered from this deal if it happens in 5 years, if that uplift happens over a 5-year period.
If that uplift happens, it's 40% increase. And of course, assuming there are no expenses between that. And that's when I'm saying, okay, it's getting interesting, but there is always a but. So now I need to check, in order to go from 200 to 280 and achieve the returns that Phil mentioned, do I need to do any work on the building? Do I need to give large incentives to the tenants? Do I need to give rent-free period? Do I need to give pay for tenant improvements? Let's say the previous tenant left and actually there was no reinstatement clause in their contract. So they were not obliged by their lease agreement to take out all the partition walls. They could just leave them in. And the new tenant comes in and they are a very nice high-tech company that they want open space everywhere. So they want the whole partitioning taken away. And they don't want to pay for that. So we have to pay for that. And that's when you start going a little bit deeper into the details to understand, okay, in order to go from 5.5 to 7.4, how much money do I need to actually pay, if any? What are my risks? Do I need a planning permit to do that? Do I need a change of use? If it was, let's say, an office that I had to convert to resi to get better numbers. And I need to understand at what period is coming. So for example, here in Athens, we have a building that has certain leases that are expiring in 2025. And I know from now that there are gonna be some new developments that started today and will be finished by 2025. So now I know that I have an older building in the same area where newer, more energy efficient buildings are coming online and will provide huge amount of space supply, will increase the supply by a huge amount of space. So that piece of information, I need to use it and put it in my model. And how do I put that in my model? I will have to assume that if the market is at 280, but in the neighboring side, there is a huge real estate office and a huge office development coming up, maybe I will not be able to charge 280 euros per square meter because they will be charging 280 euros per square meter and they're going to be brand new, shiny, and rocking. So I would have to probably assume a lower price in order to entice more price sensitive people to come into this asset. So this is how the reality starts coming into the model, into the numbers. And first, we have to figure out the reality. First, we have to understand the real facts and where things are going. And then it will become very easy to use the formulas that you guys are learning. And I'm sure the more you do them, the better you will become in creating a model. But unless we start with the fundamentals, the model will just spit out something that might look too good, but we might not be able to materialize. And maybe on that point, I will start sharing a model to show a little bit this example. So everyone has gone through the course, Phil?
No, so we've got here a mixture of people who are on the Capital Markets Accelerator program, which is our program for helping people get into industry, or if they're in industry, build their financial modeling skills to a professional standard. We've got some people here who are students who are working through the university materials that we've got. And we've got some lecturers here as well. So we're really lucky to have a mix of people.
Very good mix.
The Ascension ecosystem.
A very good mix. So I will just briefly touch upon some very fundamental parts that we put in a model. And as you can see here, we have an assumptions page where we have all the assumptions about some fundamental parts of the cash flow, like what period do we expect to make the acquisition, at what yield, closing costs, when do we expect to actually sell everything, whether we're getting any leverage, any debt. And then we have some other assumptions about the lease up. So rent-free, for example, for renewals, I'm giving 2 quarters of rent-free period for the tenant to be incentivized to stay. For new rents, I'm giving another 2 quarters of rent-free for the new comers as an incentive for them to come to our building. And then I'm making some other assumptions about operations. And let me go in the quarterly cash flow. All cash flows, the usual standard in our industry is for the cash flows to be quarterly. Why? Annually, is too bulky. Monthly is an overkill. So we feel like the middle ground is the quarterly. 4 quarters every year. If things happen in the middle of a quarter, at worst, you missed out on 1.5 months of rounding up. So we don't need the monthly, it's a little bit too much. But if it's on an annual, then it becomes very, very difficult to model leases that are expiring in the middle of a year, right? So that's why we usually do quarters. And if I were to go through what we're seeing in a cash flow, I would obviously start with a passing rent. The first thing we want to model is how much income are we getting, and then we start going through different types of expenses that a company or an investor might incur by owning a piece of property. The first one is rent-free. Rent-free, as I said earlier, is an incentive we would give to the tenant in order to come to our building or in order to extend the lease. We will basically allow them to stay in and use our area without paying any rent. The second one are void costs. So if I own a building and it has 1,000 square meters, 10,000 square feet, whatever you want to call it, of vacant area, being part of a building, as many of you might know, when you are a part of a residential building, for example, what do we pay every month or every quarter or every 6 months? We pay service charges, right? We pay common expenses. A building like a residential building, an office building, will have common expenses. And when there is, usually we pass them on to the tenants. So maybe the landlord will pay them at the beginning and then go and recharge all the tenants according to the areas that they're letting. But if some part of our building is not leased up, it means that basically there is no one to recharge. It means that we have to basically incur this cost. So our model should allow for that cost to be there so that we don't underestimate the expenses that we will have during the life of our investment when we have void areas. The other one, which is very common, is property tax, obviously, and different jurisdictions have different property taxes. In some places it's higher, in some places lower. In Cyprus, for example, it's 0. So again, we have to make sure that we don't miss out on that because this can be a meaningful amount of money.
Thanasis, is that in the UK, is that what's framed as business rates, or is that something different?
No, business rates is when you have a retail store that you're paying the business rates, as far as I know. It's only for retail. Or it's actually also for offices. You're right. No, it's also for offices. But this is something that the tenant has to pay and not the landlord. I think there are the other property taxes in the UK as well. I can't remember.
Interestingly, if I'm not mistaken, and we've probably got some commercial folk on here who can help us out with this one. Neither Thanasis or I have spent a huge amount of time investing in the UK market. We've always done international investments. So whether that's been all over Europe, all over North Africa, a bit in the US, done a little bit of UK stuff, but mostly on the resi and the build to rent side and student side, not done a whole bunch of commercial in the UK. So this is just a sense check here. My understanding is that back in the day when Centrepoint was built at the top of Oxford Street, the guy built it and he left it empty because rents were going up so quickly in the market that he knew that the value of the building would be massively increased if he left the space vacant, waited till rents had climbed, and then lease it up at the end of the climb of the rents. And if he were to rent it earlier, he would rent it at what would ultimately be lower than where the market peaks. And so he left it empty and empty and empty and empty and empty. And eventually, the local government in the UK, in London, created this thing called vacant rates. And so they created this tax for landlords that wanted to leave their property vacant.
Indeed.
So that was it. He made a shed load of money, by the way, apparently.
He did, yes. And he did very well. And he actually forced the government to create a law which was actually pretty strong. But in any case, the point here is that it could be property tax, it could be business rates, it could be something that either the landlord has to pay anyway, and you cannot actually push that down to the tenants, or maybe you only pay it when there is vacancy. There are other running costs. There are depending on what type of company you're working for, you might have other type of expenses such as asset management fees, property management fees. Property management, by the way, is when, for example, when I was working at Deutsche Bank and we had a lot of assets in the Netherlands, obviously we were managing those assets from London. That means that we were not there every day. We could not deal with the everyday life of the property. So you have to have locally a property manager doing that on your behalf. So they are the ones that will make sure that they get all the invoices for service charges. They will charge the tenants. They will make sure that they receive the rents, and so on. Business rates are paid by the occupants, says Chad. Yes, I think Chad, we agree. Yeah, indeed. So that's what the property manager does, and it's a very important part of the real estate ecosystem, if you will. Most buildings have a property manager, or most actually investors have a property manager to run the everyday life. And a lot of property managers then subcontract a lot of things to the facility manager, which is basically a company that has people on the ground, literally on the ground in the building, either for security or for the reception or for the maintenance of the elevators or for the maintenance of the air conditioning units every month, and so on and so forth. So if you want to go up the chain, you would start with the facility manager. Basically, these are the people that are in the building, doing work in the building, cleaning, changing the light bulbs if they go off and whatever. Then you have the property manager, who is responsible for the relationship with the tenants, collecting rents, sending invoices, collecting service charges, reallocating the service charges to the tenant, the common expenses, calling up the investor for when there needs to be lease up, running the lease up process, helping with the negotiation of the leases, and so on. And then from the property manager, you have the asset manager. This is when most of the times the big funds have these people based in a central location like London, Frankfurt, Paris, Milan in Italy, Madrid, New York, and so on. And they're the ones that are strategically working on the building. They are not going there every day. Maybe they're going there every quarter. And they have to make the strategic decisions. The property manager will send them reports every quarter or so, just to make sure that they know exactly what's happening with their buildings. And the asset manager is responsible to report to either directly the investors or the portfolio manager, who is reporting to the investors, and make sure that everyone is aware how the whole portfolio is doing. That's kind of the chain. So depending on where you work and how you're modeling and for whom you're modeling, you might need to include those fees in the model. For simplicity, I have not included such fees here, but very often it's the case that you have to include those fees so that you end up with the exact net cash flow that the investor will receive. Because if the investor is sitting in Singapore and it's a humongous Singaporean pension fund, obviously they're not going to spend too much time, managing assets around Europe. There is a fund that actually does that because they are so big that they need to have their own team. But there are many more other funds that they will not bother. So they will not go from Asia to Europe and try to manage the assets. They would just have a contract with the local asset manager to make an investment on their behalf and then run it on their behalf. That means that they would be charged asset management fees, and then you would need to hire also a property manager to run the everyday life of the building. These fees would need to be part of this cash flow and would obviously eat up part of the returns of the investor. At the same time, though, the investor would be saving money by not having to establish an office in a remote location compared to where it is their base. Other expenses include insurance. Most of the landlords pay for their insurance. Sometimes you can actually also pass it to the tenants, but there needs to be insurance in the building, insurance against liabilities. In, let's say, a stone falls off of one of your balconies and hits someone, you need to be covered by insurance. There is an earthquake if you are in a location where there are earthquakes. floods, and other things like that. So you always need an insurance. And again, if you work in a fund, chances are that you will need valuations every 6 to 12 months. So you need to pay a valuer to update the valuation. So this would be kind of a broad group of expenses you would need to include in your model, making sure that basically you reflect them correctly in the model. And intentionally, I have made a couple of mistakes in this model, and I will go through later, and I'll show you some sanity checks, some smart ways to check your model, and we'll see. I intentionally left some mistakes there just to show how we can spot them, and then how we can go and fix them.
Thanasis, can I just ask? This is a particularly kind of well-structured, tidy-looking model. Is this quite a common layout that you would have to build if you work as an investor?
Yes, it's a very common layout, Phil. So you would have rents, expenses, net income, or EBITDA, depending on how your company tends to call it. Then you would have the purchase price, the sale proceeds, because I buy something, I get the rents, I sell it at the end to make a profit. Taxes, and then you would basically model the debt. So leverage on the acquisition. In that case, I have assumed 55% loan to value. So for every euro, every pound, I would get 55 pence or 55 euro cents of loan to pay the purchase price. And then I would obviously be paying interest on that and some amortization. And then I would be getting my my dividends from the investment as I show here. Then in the model, you would have a number of other things which are mostly supportive. So you would have a profit and loss statement. The reason you would have a profit and loss statement is because in some jurisdictions, you would have to account for depreciation, which basically reduces your taxable income. And then you would have to calculate your tax. So if I want to have an accurate tax estimate, I would have to try to imitate the accounting principles and the tax principles of that jurisdiction. And usually you do that through your P&L. And then a number of other tables that help you calculate different things like your exit price, so that you end up with this cash flow statement. And one way to have a better picture or a broader picture, if you will, or a more high-level picture, and also spot some mistakes, would be to have exactly that cash flow. So this is the source, and add up every 4 quarters, add up to 1 year. So then you end up with an annual cash flow like that. And in that one statement, I can see immediately that I'm buying this portfolio for 100 million, and I'm selling it for 128 million. And in the meantime, I'm receiving rents, which are dropping because I'm selling some of the properties on the go. I'm not selling everything in one go. And I have expenses. I have this is my net operating income, and then I pay the debt and everything else. So that gives me a very quick, high-level look in the model. Any questions so far?
In industry, would you use Excel or a certain software for modeling?
Yeah, Thomas, we use Excel. We always used Excel. Most private equity funds use Excel, or hedge funds, they use Excel. Some property companies that I know in London, for example, they use also Argus or similar programs. The argument was always that Argus is ready-made for you to plug in a few numbers and spit out the result. And apparently they keep making it more and more flexible. The preference for Excel is that you can basically model whatever you want, whatever structure you want. You can add or remove things. So it's a little bit like a small developer, if you will, but in a much more user-friendly way.
When you hire people for Thanasis, if they can use Argus and not Excel, is that okay?
Not for me, unfortunately. And the reason being, again, we want flexibility. No deal is like the other. It's amazing, guys. I've done like more than, I don't know, now it's 2.5, 3 billion euros of transactions in portfolios, single assets, long-term leased assets, short-term leased assets, repositioning of assets, hotels, whatever you name it. None of them was similar to the other, with very, very few exceptions. When we are buying plain vanilla super core buildings in the city of London, when we have bought 2 of those and they had 20-year long leases, nothing else was ever the same. So I prefer people that know how to model, because then we can easily and quickly adjust the cash flows. To give you an example, let's say lately we're trying to achieve better returns by not buying simply a finished asset, but by co-developing an asset with a developer. So a developer comes, or we go and we find a plot, and we decide to build a logistics a shed. And let's say we do it 50-50 with the developer. So we go together, they find the land plot, they get permitting, they show us the deal, and we come into the deal. We have a budget for the costs. We pay for the development costs. In the meantime, we go out in the market, we find a tenant, we lease it up. And the moment the asset is completed, then we can turn on the engine and the tenant can get in and start paying rent. The developer's job finishes and they sell their 50% of the building to us for a pre-agreed yield. I don't know if Argus can do all that, but to be honest, I would prefer that I see it on an Excel spreadsheet, because that's when I know that the numbers I see make sense and I can trust the numbers. And I will show you what I mean also here. I'll do a few checks that maybe they will seem daunting at the beginning, but I just want to show you the power you have here if you know how to use this tool.
There's just to interject there a second, there's this funny comparison that I have with this, which is, so Thanasis and I've worked side by side for many years in private equity and investing, and just through life generally. But I have never worked with or met a person that uses Excel in industry, Argus in industry, or any of the valuation softwares. You can find the core fund guys and gals will use Argus from time to time. We don't really tend to do that many deals. If the deal is very straightforward and very simple, the maths aren't very complicated, it's quite easy to use a valuation package to do it. But most of the deals that we've ever done are all value add and opportunistic. And so they're unique, they're one of a kind each one. And so you need to just build it up. But the way I compare it is, if you are a person in Thanasis's situation, it is not uncommon that in a year you may make $1 million plus. And so you are kind of at a certain level in the industry where you have to be quite skilled to get there. And in the world of investing, that's more like getting into the higher echelons. That's like, if you're an athlete, you're more an Olympian type athlete than you are someone that's kind of going for a jog on the weekend. So take it if you're Michael Phelps, right? Michael Phelps he's a swimmer. He swims. He's very, very good at swimming. He's world class at swimming. He gets paid a lot for being a great swimmer. That's really what an investor is. You become a really, really good investor. You work hard. You build all the skills you need to be an investor. One of those skills to be an investor is cash flow modeling. In fact, it is how you make money. It's how you think about deals. It's how you transact on deals. Cash flow modeling is core, and Excel is the tool that you use for your cash flow modeling. Argus is not a tool for cash flow modeling. Argus is a tool to avoid cash flow modeling. And so Michael Phelps does not use armbands. He's a swimmer. Thanasis does not use Argus. He's an investor. It's that kind of,
yeah. Very interesting metaphor, Phil.
I think that's it, though, right? In the value add and the opportunistic world, if you get someone that comes on and says, "I don't know cash flows, but I'd love to be an opportunistic investor," don't think so.
Yeah, you cannot. And I mean, recently we were bidding, for example, for a portfolio, and look, there are different layers in real estate investment. Okay, the first layer is the building itself. So first, you need to make sure that you understand the cash flows of the building itself. Then you go to a layer above and you need to start understanding the cash flows of the investor or the owner or the owning company of that asset. And as I said, for example, you have to model the asset management fees or the property management fees. And then you have to also model the financial structure, the equity structure, the capital structure, as we call it, of the deal. So what is the debt? How much is the debt? How much is the equity? And then in our world, there are so many other layers you can add on that. For example, you have common equity and you have preferred equity, which has different rights. And preferred equity would basically get certain returns before the common equity, and then the common equity will start getting their money and so on. So that needs special modeling. Then you have senior debt, and you might also have mezzanine debt. All these things come not only with different structures and different layers, which maybe at some point you can create a template, but they also come with different terms, and then you need to model those different terms. So in the beginning, it sounds a little bit too much and overwhelming, but once you start doing it a few times and you get out of the way the difficulty of remembering the formula, you start focusing on the actual information. It's like playing the piano, okay? Where first you read the score and you try to see this little black point, you're looking on the pentagram, which note is it and where this note goes on the keyboard. Then you get that right. Then you get it, you can do that faster, and then you can do it without looking, and suddenly you can play a song. You can play a musical piece. And after you can play a musical piece, you become that good that you can actually now compose a musical piece. And with just playing on the keyboard, your ear and your intuition gets you to a melody that actually sounds right, with harmonies that actually make sense. It's very similar with Excel. You get the formulas out of the way, you just crunch it and crunch it. It doesn't take too long, to be honest, but it does take some exercise. Like everything in life, there is nothing in life that comes without a little bit of exercise. But at least this exercise also pays you. Okay, there is a lot of exercise that does not pay you, only gives you pleasure. At least this one can also pay your bills. And then you start going, okay, now that I can quickly do the formulas, let's see what the numbers are telling me. So I will answer quickly this question from Usman: where the Capex expenditures go? Basically, capital expenditures, where do they go? In this case, I use it as TIs, tenant improvements. So that's the line I put, basically the Capex in the specific model. But it could very well be a separate line if there is a lot of capital expenditure for huge refurbishments or repositioning of a building. It can be a huge line with its own modeling assumptions that you would have to incorporate here. And that would be a whole new story. Like you would have architect fees, planning fees, project manager fees, contractors, and so on and so forth. And then the period over which these fees would be paid, so that you can have your Capex laid out in your model.
I think, and Thanasis, sorry, just to cut in there. So I think, what you were saying there is, it's like there are these, like, I think of them as 4 stages of modeling. The first stage of modeling is, I can't represent what I think in my mind on Excel. The next stage is, oh my goodness, I can represent what I think in Excel. This is great. The next stage is beast mode, which is horrible for everyone. It's where you make everything super complex because you can nail these crazily complex formula and you feel super powerful and your models are very, very complicated. And then you go over the other side, which is where you make nice, simple models again, because you know how to build the bits that matter. And funnily enough, we've got here Carol, Ed, Antonia, Diane, and a bunch of other people that are all on the Capital Markets Accelerator program, where we are building the skills so that hopefully we get beyond the beast mode and we get back into like okay, I know how to simplify my model to the stage where I can represent something like this, which is this is actually a very simple model that you've got here, frankly. It's a very nice, tidy model.
Yes.
But that's what
you can do a lot of things with that. You can do a lot of things with this model. And it's easy. Once you have the basic structure, it's so easy to add other layers on top of complexity. Because you just build on top of each other. And as long as the lower layers keep working, they will fit the higher levels, the layers, and the higher layers, and the higher layers, and one will fit from the other. So as long as the bottom one works and every other layer works, it will always be working all together. And very good point, Phil, about simplicity. When Phil and I joined and started, there was almost a competition between analysts and associates who will write more lines on each formula. Let me tell you, this is absolutely disastrous for a number of reasons. At some point, first of all, you don't know what you wrote there. You don't remember at some point. So you cannot figure out and understand whether that had any sense. You cannot audit it. It's very difficult to go back and understand it's part of the formula, and so on and so forth. So what I will show you here is a tab of projections where, exactly in order to simplify the model, we break it into pieces. And here are some of those pieces. Let's say that these are 5 different buildings, and this is the area in square meters, okay? So very easy. Let's say that I receive, this is a very simplified type of tenancy schedule. Usually you would receive a table with the floor, the name of the tenant, the area they are occupying, the rent per square meter or per square foot, the lease start date, lease stop date, break option, and so on and so forth. So it will be there. So here's a very simple version of that, where I'm not even saying the name of the tenant. I'm just saying that this tenant, the lease is expiring in quarter 12, in quarter 16, and so on. This is the current passing rent. And these are, then I'm starting with some assumptions on how many, what are the void costs? So what is the cost per square meter per annum on the service charges, essentially? What is the ERV? And here you see I have an average of 280 euros. Indexation, I have to make an assumption on how fast the rents will increase every year. In many cases, like in Greece, for example, these are inflation-linked leases. So if they increase every year by last year's inflation, or last year's inflation plus 1%, and so on. And then comes the more soft part, the soft skill, which is the renewal switch. So here I have to make an assumption on whether this tenant will actually stay or will actually vacate the property, and I have to find someone else. And this can be done by literally speaking to them, understanding their needs, understanding whether they like the place, whether they want to expand or they want to shrink, actually. And based on that, you can have either a feeling, or maybe they're telling in your face, you know what, I hate this place, I'm leaving. Or maybe they will tell you, I love it, but I'm doubling in space. I am a huge company now. I hired another 100 people. Either you give me more space, or I have to find another place. Okay. So here I made an assumption that only these 2 tenants actually stay. This is the ERV. Again, the ERV growth. I have to make an assumption how fast the market will grow. And that's, again, one way to figure that out is looking at market reports from property advisors. These are the tenant improvements per square meter. So I'm saying here that I'm going to spend 100 euros per square meter when a tenant leaves to fix the place. Again, that's an assumption. I will have my technical department to work and go and assess the property and say, you know, what changes I need to make, or maybe I will just make an allowance, to be honest. Maybe I will not know. I will just make an allowance. And here, because it's a portfolio model, I have assumed that I sell the different buildings in different periods of time. Okay, so once I relet them or I extend the leases, I'm just selling. That's my business plan. It's a very simple business plan. I take an under-rented building, I revert it to the market rent, so I increase the rent, and then I sell it, and that's it. It's a very simple business plan. If I take this passing rent, okay, and as we said at the beginning of the discussion, I'm buying that for 5.5 yield. So I'm expecting, and here I'm starting now to go through some sanity checks I will be doing in the model to see if my numbers look fine. One check is the following. I know that when I bought the building, I was getting 5.5 million. Okay, I know that because that's the building I bought. If you remember, we said that the building is 38% under let. So assuming that all tenants go and I can revert to market, so I'm switching everything to 0. After quarter, when is the last tenant expiring? In quarter 16. So from quarter 17 onwards, if all the leases have now gone to the market level, I should be going to my cash flow, and from 5.5 million annual rents, I should be seeing something close to 7.4. Let's see. I see gaps, which are void periods. And then after quarter 16, 17. So why is it 17? Because these guys are leaving. This is quarter 16. Yeah, that was the second one.
Does this structure look familiar to anybody, by the way? So everyone here that's in some way learned some version of modeling, does this structure stand out as being familiar to you? So, yes, no, completely new? Thanks, Carol. Carol says yes. That's good.
Good.
What you'll find is that there's just not a huge amount of variance in the way models are made in the industry, because once you find a format, a structure that works, you know, someone that's a Deutsche Bank moves to Morgan Stanley, someone that's Morgan Stanley moves to Blackstone, someone at Blackstone moves to such and such. And when you do joint ventures and deals together, you all basically share the same models with each other. So once you learn how to do this, you're good.
Yes.
You can basically hack anything together once you're this far, and you'll handle it in industry.
And some people might use different language in certain points, but eventually you'll figure it out. So if you go in this case, and here is the quarterly rent from each of the buildings, which then I multiply by 4 to make it annual, you will see that I'm getting rents of 8.2 million. It's like, this is my first red flag saying, okay, I remember that the average rent, market rent here was 281 euros per square meter. So if I multiply that with 26,500 square meters, I should be getting 7.45 million. Why am I getting 8 million? I like it because it's more, but why? I need to understand why to make sure my model works. Does anyone have any idea why would that be the case? Any ideas? I mentioned it earlier briefly. I made some assumptions about something earlier.
A 2% increase maybe every year?
Yes, Thomas, exactly. So I made an assumption that ERV is growing. So yes, today ERV is 280 euros, but by the time the asset will be vacated and relet, the ERV will have grown. So let me make the growth 0. Let's see what happens now. Quarter 17. Yeah, I have void left, boom. 7,587. So slightly more. Why would that be now? The ERV has not grown. It's left at 280. It would be the same reason, as a very similar reason. While as the first leases expire and they are relet, now the new lease is actually subject to indexation. So by the time that the other lease has expired, the other building has already increased the passing rent. So let's make the indexation 0 as well, and go to my model and see that indeed now I have 7.45 million of annualized rents. So basically, what does it say? It says that every quarter between October to December 2022, I was receiving for each building those rents, 1.3 million. Until building 1 here expired, tenant vacated, it was left empty for 4 quarters, and then it was related market. Same here. When was it? Until quarter 16. Yes, quarter 16, boom. Empty in quarter 17. Same here. Go back. Lease expiry, quarter 12. Therefore, I would expect to see a void in quarter 13. Yes, quarter 13, I see a void. So now I'm kind of getting my head around it, and I can see that the revenues work. What else have I said? I've said that I have 2 months rent-free, right? Do you remember my assumptions? I have 2 quarters, sorry, not 2 months, 2 quarters, so 6 months rent-free for renewals or for new leases. So I'll go to my projections, and a lot of people model the rent-free as lack of rent. So they try to make the model show no rent. The way I prefer to show it is by showing the rent, but then offsetting it with a similar amount of rents. So here I have my renewal rent, and I am offsetting it with this. Okay. So that's the other point, rent-free. And what does this help me with? It's very simple. I can tell you in one go by just summing up those numbers that in my business plan, I'm foregoing 3.7 million worth of rents as tenant incentives and rent-free. So now I know that from an annual rent of 7.4 million, half of that, and I was expecting would be half of that, right? Because my ERV was 7.4 million, and I'm giving half a year of rent-free. So I'm supposed to give half of 7.4. I'm supposed to give 3.7 million away. I'm giving it out as rent-free. So indeed, my model verifies that I have forgone basically 3.7 million of rents. Okay, and so I know that this works as well. And then I go and I have other points like tenant improvements. So as you can see, this is my scrapbook. The projections tab is my scrapbook. I make all my calculations there, and I try to break it into small pieces so that it's very, very, very easy to follow with very small and easy to audit formulas. Void cost, for example. I know it's 48 euros per year. So divide that by 12 by 4, it's around 12 euros per square meter every quarter. So all I have to do is multiply that by the area, and I know that for this period that my asset remains vacant, I have to pay 288,000 euros in service charges because of the vacant area. So again, very easily I can now calculate these amounts, and in the end I will very easily calculate how much money I made, how much money I had to pay in expenses, and so on and so forth. Property tax is 0.10% of the value of the building. So let's do a sanity check. It's 0.10% of the value of the building. And actually, so of all the buildings. So that's 100 million. All my buildings were bought for 100 million. So every year I should be paying 100,000, yeah, in property tax. So I go to my model and I see that every quarter I pay 100,000 for property tax. What did I do wrong?
The classic error.
The classic error. That's why I'm highlighting that and I'm asking, because everyone does it. I've done it many times. So this is a quarterly model. So I have an annual number, an annual figure that I have calculated. What do I need to do to put it in a quarterly model?
Divide by 4.
Yes, Chad. Thanks so much. So my calculation was correct, but only for an annual. I should have divided it by 4. Okay.
I noticed you did something there, Thanasis. You changed the formula in one cell and you copied and pasted it across the whole line. So you don't have different formula along the line. You've got the same formula all the way along. Is that normal?
Yes, very good point. It's not normal. It's the rule. You should not do anything else other than that unless you have very clearly pointed out the cell that has a different formula. So every line should have the same formula throughout. And this formula, so what did I do? I said, take 0.10%, take actually minus 0.10% of 100 million, which is the total value of the assets, and divide it by 4. Then I want to copy that to the other cells. And one way to do it is Alt-S, copy formulas. I do that, and I get Pollux. Why?
You didn't anchor it.
I did not anchor it.
Ah!
So anchoring is when I want to copy a formula to the right, but I want the formula to always refer to this 0.1%. So I want it to, this cell, I want it to be 0.10 multiplied by 100. This cell, I want it to be again 0.10, but this time multiplied by this 100, and so on and so forth. So if I want this 0.10 to always be there, I will have to anchor it. So now that I'm going to copy paste it, the formula, very quickly, in one go, I did not have to go and copy each one here. I did not have to go here and drag like that to copy it. It's much easier. I just do Control-C, then Shift-Control, go to the end, and Alt-E-S, F, and here you go. And all these things, Phil has put together an amazing program to teach you how to do it very quickly. It's nothing magic, it's just repetition.
Can I just to cut in there? One of the reasons why you always have the same formula along a row in industry is because imagine Thanasis is given this model by his analyst or associate. If he looks at the formula all down one column, he looks from row to row to row, looks down he looks row to row to row in a single column, he can understand how the whole model works just by looking in one column. So within, let's say, 100 cells, you know all of the model. If you change any of the formula in cells, he would have to look through every single cell in the whole model to understand how the whole thing works. It's nonsense. You just don't do it. So one of the first things you learn is your formula are always the same all the way along a row without exception. Otherwise, it's that kind of thing genuinely that in time will get you fired because you end up making all sorts of weird things throughout your model. You won't remember it. Other people won't be able to see it, and your model won't make any sense.
Exactly. Exactly. So, this is again, as Phil said, we started with this column. I've put the formulas here, and then I've copied them throughout. And once you do it, it's so easy to just basically, you almost have to model this column. Then you would go here and almost do copy to the right, and everything is done. So let's do another sanity check. I would expect now that, let's say that I'm actually selling everything at the same time in quarter 22 for simplicity. So that's 5.5 years. More or less, I should be receiving for the first 3 years, I should be receiving 5.5 million in my mind. And then I should be receiving 7.4 for the next 2 years. 7.4 for or 2.5 years, let's call it. So all in all, I must receive around 35 million. Let's see if I'm even close to that. I go to my quarterly cash flow and I basically highlight this row. By highlighting it automatically the model will give you an average, will count how many cells you have actually highlighted, and will also give you a sum. So my sum here says 27 million. So I know that there's something I must be doing wrong, okay? There is something that I must be doing wrong, and maybe there is some double counting. I go here and realize that this is based on my projections and actually is connected to the wrong cell. So I go back and fix that. So again, these are sanity checks we are doing in order to go. This is actually a sanity check I would be doing when an analyst gives me a model, because I cannot really go through and go through its formula and understand its formula every time. It's just not enough time. So what you have to do is basically do some sanity checks and calculate and then see if you can fix it. So here I connected it with line 18 when I should have connected it perhaps with line 104. Now you see that the sum is actually closer to 33 million, which is very close to 35 million. Okay, so we're discussing here how to understand cash flows, okay? And you won't understand cash flows until you know what to expect when you're reading a cash flow. So now here, I knew what to expect. I knew that if my 1, 2, 3, 4 leases are expiring in almost 3 years. 12 quarters is 3 years, right? So, and another one is expiring in 4 years. So that means I'm left with another almost 2 years of the new rent coming in. And that's how I did this calculation that I showed you earlier. And in my mind, I'm saying I should be receiving around 32, 33, 34, 35 million of income. I went in my model, I added up, it was not right. And I had to go back and check my formulas. Obviously, in that case, I knew what I did wrong because it was on purpose. That's why I went quickly and fixed it. Then, if you remember, I'm supposed to give 2 quarters of rent-free. So I would expect that my rent-free in my cash flow is equal to 2 quarters, 6 months. 6 months is half a year. 1 full year, if you remember, was 7.4 million, the market rent. So half a year, I should be seeing here rent-free of 3.7 million. Let's see. No, I'm looking at rent-free of 6.4 million. So I know that again, there is a mistake here. So I need to go back and fix that. Yeah, thanks for, I'm just reading the chat in case there was a question. Thanks, Phil, for picking this up.
Thanasis, just a quick question.
Sure, chat, yes, thanks.
So would it be reasonable to expect then that, for instance, when someone brings a model to you, you should have a lot of these checks built in, like even if you do like a on the side like you model it so that if like the sums don't add up, then there's a yes or no, like maybe add some conditional.
Yes, please. Yes, please.
Yeah.
If I have an analyst that does that, extra credits, brownie points, and better bonus. Absolutely, you're spot on, Chad. Why? Because you're making my life easier. The more easy you make the life of the boss, the more happy he is. The more happy he is, the better he will actually promote you and pay you. It's very simple life, you know. It's that simple. So also at the same time, you will be saving hours from your time and your pleasure in the evening from having to go through against like and doing mistakes that you were not aware of, and then someone picks them up and you feel like shit because why didn't I not pick it up myself, and why did this guy have to find it? So very smart question. If you can do that, it would be absolutely fantastic. Yes, and very often we are trying to build this type of safety features to cross-check certain things. One example like that actually is this check over here. So this here, I have my investor cash flows, and the check I did is I wanted to make sure that my levered cash flows, my cash flows after debt, are equal, the total amount, with the cash flows I saw here for my investor. So the sum is 0 because one minus the other, because they are equal, it's 0. So I know that it works. So the moment between this table here and this line here, I have these lines. So if this is not 0, I know that I messed up something here, which coincidentally, it was messed up before I fixed it and to show it to you guys. I was working on that earlier. So yes, it picked up something, and then I went to these formulas and where they were referring, and I fixed it. So that is super extra points if you get it done.
There was a funny thing talking about that. I was working with this guy who was like a guy called Dan Protz. He was a gold medal Olympic rower, or no, not Olympic, like world champion rower. So it's a slightly different competition, but similar level. And
Wharton versus, what was it? Wharton versus Columbia?
I can't remember.
Yeah.
He was Stanford. He was
Stanford versus Watford, yeah.
Yeah. So he was at Stanford MBA, and then he went off and did this like gold medal world champion rowing thing. And I was partnered with him on this project. He was the associate, I was the analyst. And he was like, hey, Phil, why don't we get this shit done? And we'll go ice climbing in Slovenia. And I was like, first of all, I don't know anything about ice climbing, but this sounds insanely cool. There is no way in hell I would say no to go ice climbing with this dude in Slovenia. No idea. So I was like, yeah, 100%. And we had this director who was running this deal. And it was a deal where we were buying land plots in the Czech Republic. It was a messy land aggregation deal. And so this director was an Israeli tank commander. And he was like, listen, use my model template, just use my model. I understand my model. It's got the checks built in. Use my model and deliver it to me. And I was like, okay, fine. So I spent like 2 days working on this with this associate guy. And we were working super hard. And this model was such a beast. It was such a horrific Frankenstein monster of a model because it had been used over and over again and like adjusted to different kind of scenarios. I was like, hey, sod it. I'll just build a model from scratch. So we deleted just built up a new Excel, built a whole model from scratch. And it was 2 hours before we were leaving for our Slovenia ice climbing trip. And me and this dude go up to the Israeli tank commander's desk, deliver the model and go, nailed it. Do you want to go through it? And the guy's like, yeah. Okay, sit down. So opens the model and he goes, what's this? I said, well, it's the model. And he goes, it's not my template. It's like, I know it's not your template, but your template was a monster. And he literally closed it and deleted it. It was days of work. And he said, I want the model now. Go work on the model. And that was it. I never went ice climbing.
You went ice climbing.
Ice climbing.
I remember that.
Ironically, or not ironically, he broke his back ice climbing. That was unfortunate, although he now still ice climbs, but has a big chunk of metal in it. Crazy guy. That was funny.
Crazy guy. Indeed. Maybe saved you from trouble, Phil. Most
But
probably.
that's why often people, as they get more senior, do not want you. They want clarity, simplicity. They want to know that the model works, and they don't want some analyst that doesn't have the experience building a new version. They also don't want to adjust their mindset. So you kind of have to adapt. You have to have enough skill that you can adapt to thinking the way that they think of representing the way they want it. And often, just like Chad questioned, you have all the checks built into these models that these guys are using. So it makes life very, very simple for them to do the deal.
It's easier because they are more familiar, and the more comfort they feel with your work, the easier they will go through that, and the easier they will focus on the important things. And you'll see that every person wants it in a different way, by the way. Yeah? There are some rules, there are some standards, but at the same time, everyone is used to their own models or their own templates, which have slight difference from each other. I don't know, I read a text earlier on the chat about Europe versus US compared to US standards. I don't know if it has to do with continents, or whether it's just simply different companies have different, slightly different structures. eventually they all do the same job, and eventually you spend one day on a different model, you figure it out, and you can adjust your modeling to that way. So it doesn't take long once you actually master it. Yeah, Chad.
Yeah, just a quick question, because it's only like in the last couple of months. I think it was on a call with Phil, and it's about the US and European modeling. So, like for instance, I'm very accustomed to using a lot of if statements and so on. And then I was like, Phil was like, oh gosh, don't use if statements, use conditional statements.
Yes.
So is that something that you guys see as well in Athens? Like, is it simply conditional statements and forget about if statements?
Yeah, if we don't use that much, if can be so long that you will never finish, because there are so many there can be so many ifs in one formula. So yeah, we don't do it as much. We prefer to do the conditional, and it's so much easier because it's binary. It's like true, false, true, false, true, false. So you have the and the bracket, or the or and the bracket, and you have inside whatever condition you want to put. And it's so simple. After I realized that, I was wondering why was I using if so much. Yeah, I think the answer is that Microsoft has created certain features that are easy for people to understand. So when you put an if formula, it also guides you through how to finish it.
Exactly what is correct. Yeah.
So it's easier for some people because they're guided through that. But once you know that there is a conditional thing there, and let me show you an example. Everything is done with conditionals. Look at that here. I just fixed, if you remember, the rent-free was wrong. So I just fixed the rent-free. Now it is 3.7 million, right? Half of 7.4 because it's 6 months. So now it's fixed. How did I fix it? Conditional, I said, rent-free. I have a table that calculates the rent-free for renewals. So if they renew, it means that it will take minus the rent that they were paying for 2 quarters. And I have another table saying rent-free for new tenants. So either you should have rent-free for renewals or for new tenants, depending on whether your switch says that the tenant will vacate or not vacate. So all I did is take this switch, transfer it here. So because this switch is no renewal, 0 means no, right, in Excel. So no renewals. So all I do is take the formula that I had created earlier, which was that part. And you can see here, Chad, I have 2 conditionals. One is an and this condition says, as long as the quarter is bigger than, is bigger or equal than quarter 13 and less than quarter 15, then take minus the rent. So that's what the model was doing earlier. This is the rent that it's taking. And now I'm going and saying, but multiply it with the switch. So when the switch is 0, whatever the formula says, I don't care. Just take 0. And now the whole table here is empty. So only this table now plays. And it's 3.75 million. Before, I did not have this switch. And that's why I had more rent-free than I wanted, because the model was taking both, was calculating rent-free when it should not. So now I just went back. I said, okay, very nice formula. As what we all know in mathematics, if you multiply something with 0, whatever this something is, then the outcome is 0. So I multiply with that, anchor it only to the right, copy paste, and boom, disappeared. Everything now is multiplied by 0. And when I go back and change a few tenants, let's say that actually this tenant will stay. Let's see what happens. Let's go to that line. And here it is. Line 2. Now it appeared on the renewals and it disappeared from the new tenants. So look how quickly I can automate one simple process with just one switch.
And I think the good thing about learning conditional statements as an example rather than if statements, when you learn conditional statements, it allows you from first principles to build a switch like that, build and represent what you're thinking in your mind quite simply in Excel. But if you don't ever get to the point where you understand and utilize conditional statements, you're forever in this world of overcomplicating the structure, overcomplicating the formula. So it's that funny thing where it's like I was saying, you can go into beast mode. Beast mode has like 4 lines of if statements.
Let me give you this example. Look, let's make that this example. So if here I would have to say if renewal is 0, is 1, comma,
Then,
if true.
yeah.
If quarter is more than or equal quarter 13, comma, if is less than 15, then take this. If not, and then I start ifing the rest of it. So I'm already in line 3 and I'm still ifing. So it's like, and look how quickly I did it. It's not even one line, it's like 1/4.
Yeah, I can definitely say that because as I said, I've only I used to use a lot of if statements before, and since using conditional statements the last couple of months, it has really made modeling much slicker, much cleaner. It's just much more simple at the end of the day.
Exactly.
Elegant modeling.
Elegant.
That's the word.
That's a word. So just to kind of round it up and see what else, what's the last part I would be seeing in a model? Let's say I've gone through the cash flows make sense, and now I go back and calculate my annualized cash flows. What do I see? As expected, I make let's make sure we sell everything in here. So let's make this. Let's make everything a renewal, for example. Or no, let's actually change everything to no renewal. Selling in quarter 22. Let's make it 23. So I'm here. I am taking my annual rents. And I can see I'm making 100 million. I'm getting my rents. I'm paying my TIs. I have my kind of unlevered cash flows. The last thing I want to check is, okay, usually when we make a big acquisition in the fund, we usually take leverage. We usually take a bank loan. And the bank loan is, in our times, between, I would say, if you are a REIT, anywhere between 40 and 55%. REITs are a bit more conservative. If you are a more value-add investor, maybe you will take 55 to 60%, somewhere around there. Even if you're an opportunistic investor, the bank may give you up to 70% loan to value under certain conditions, but not much more. In the previous cycle, when everything exploded back in 2008, a lot of that was because the banks were actually giving 95% loan to value. So for 100 million acquisition, I could actually get 95 million of leverage and only put 5 million of my own money. As you can imagine, this building belongs more to the banks than to us. So this changed a lot since the previous global financial crisis. And we're now, let's say, in the region of 50, 55, 60%. So in this case, I assumed 55% because I'm a relatively not too aggressive investor. So the other thing that I want to check is, am I making enough money to pay my interest with my income? So here I make, 4.2 million, and I have to cover 1.3 million of interest, and I have to cover another 1.1 million of debt repayments. So I know for a fact that if these two make 2.4 million, I have a net, and actually this tax is not actual because then there is a tax shield here. So the actual tax is actually 500,000. But even before taxes, let's say I have 5 million of cash, and I can use that to cover 2.4 million of debt service. Let's take that out of here. It's because I did not correctly put sum here. Let me delete that and put a U here, sum. So what am I saying here is very simple. My income is 2.1 times my debt service. So I know I have twice the money I need from my rents to cover my debt service. And usually this is thumbs up for me. This is like, okay, I have enough buffer to know that I can cover my debt. So I won't have an issue paying the bank, and the bank won't have an excuse to come and foreclose on my asset. And that's a very important kind of sanity check and also control, basically, that the leverage you're taking is okay. You can service your debt. So that's a very important part. So then I go back and check my IRR. Here I did not do any. I remember we made zero all the indexations. We have a lot of expenses. So yes, although we calculated with Phil that we should be getting a lot of money from the rents, we did not calculate, because it was a back of the envelope, that we also have to incur a lot of expenses while we're doing that, and also tenants improvements. So now that my model gives me all those numbers, I can see that I bought something for 100 million. I sold it for 128 million. In the meantime, I received net cash flow of another 23 million. Yeah, so basically all in all, this should add up to what, 151 million. I paid 100, so basically I made 50 million. I paid my amortization, and this is, which reduced obviously my profit, and I got a 6.6% IRR. By using the leverage. Sorry, Phil, yeah?
Sounds a bit low, doesn't it? I would have pegged it at more like 8% if you're getting a 50% uplift over 5 years, compounding.
Yes, because exactly. But the whole point was that I needed to make sure I calculate the cost of achieving that increase. And although on paper it sounded a lot, I also had to pay to give a lot of incentives. And I had to also I had a lot of expenses that I did not account for.
Hey, question, do you cap those operating costs, or are you capping the passing rent?
Very good question. It depends on the jurisdiction. So in the Netherlands, for example, when they quote a yield, they quote a net yield. In Greece, we usually quote gross yields. So it would be just the rent.
Okay. Thank you.
I think in the UK, you also have the net initial yield, which basically means the gross rents divided by not only the cost of the acquisition of the asset, but also the acquisition costs.
For the purchase.
The purchase cost, because you have to pay stamp duty and stuff like that, transfer tax.
But interestingly, in the UK, there's no standard as to whether or not you include rent-frees and TIs and things like that within your NOI. You have to do it on a case-by-case basis.
Yeah.
Hey, just a quick question for everybody. Just thinking, we don't have a huge amount of time left. We've probably got another 15 minutes or so, 20 minutes. Did we want to spend some time asking Thanasis questions about what he's seeing in the market, or any more REIT-specific questions, or spend more time on the modeling?
I'd like to ask a question about REITs, if possible.
Of course.
When you finish your modeling.
Look, guys, I don't want to spend too much more time, because then it's becoming very daunting and difficult to follow. It's also late for some people. So I think I covered most of the things I wanted to show you from a high level, just to show you what you can do, what eventually you'll be doing, and how you might be able to draw conclusions on that. Just to answer to Chad, the tax shield I have here, Chad, in your question, is nothing to do with our REIT. It's just a model that I happen to have for a company. So it's company related, not a REIT related, because as you very well pointed out, REITs do not have tax. So that's relating to a company that would be paying normal income tax. Paul, is that you who wanted to ask something about REIT?
Yeah. Basically, I was just asking your opinion. I was talking to Phil about this earlier. Amazon came out with some. Well, their share price got clattered the other day based on the back of, we've got inflation, we've got quantitative tightening, we've got commodity prices, people spending money on fuel rather than goods. So is that gonna, have we seen the peak of the logistics market, or the underlying continuation of push into online retail, is that going to outweigh it still, or has logistics had its day for now, in your opinion?
My first feeling is that the markets always overreact to a certain extent, and if you look at their share prices, they do that a lot. If you do what Elon Musk does with Twitter, suddenly Tesla shares move around as if that has anything to do with Tesla. So a lot of things are related, and a lot of other things are more impression driven. What I can tell you, no one knows exactly how much the days of the logistics have, whether they have passed or not. I have a feeling that probably not. I have my feeling is that logistics are becoming more and more important. Last mile logistics are becoming more important. Dark stores are becoming more important because speed in delivery is also becoming more important. And people are just getting more and more spoiled. Remember, we used to order Amazon and be happy that we received it 2 days later. Then we have the one-click button and you receive it also tomorrow. And suddenly now you can actually receive it in an hour, and still sometimes we want faster. So there might be. Don't forget, we went through a pandemic, and pandemic meant we are at home, and it meant that we could only order online, and therefore the requirements for logistics became really huge. Now we are in a situation where things feel and are a bit more gloomy, and as a result, people are more cautious, and maybe they will spend less and they will order less crap from Amazon. So I think that's what we're seeing now, but I cannot believe that we will go back. Requiring less logistics means doing less online. It means we're going back to the high street. So does this mean that the high street is going to live, it's going to go back to the glory days? I think this is a trend that is not going back. Maybe people will spend less or more depending on how comfortable they feel with their lives and their surrounding circumstances. But I don't expect. So yes, you will see demand going up and down, but that's always a result of the economy. That's always a result of the geopolitics. We have a huge geopolitical issue in our doorstep, and that creates also energy concerns. That creates uncertainty for people about their own safety. Back in Greece, for example, in 5 years ago, we had the influx of immigrants. That had a huge effect. So I think logistics, and also wherever I see logistics, I don't think it's had its day. What it may have had is the yield compression. I think buying logistics at 4.5%, personally, I find it very odd. In Greece, we're still at 7, thankfully. We started at 9, and we're still fighting our way to get above 7. And we still feel, when we do 7, 6.9, we feel that we're kind of being robbed. I would not easily go below that. The point with logistics, just to keep in mind, when you are in Poland, when you are in Romania, even the UK, as long as there are huge plots of land somewhere outside the city, the supply can become much, much more. So it's a piece of real estate where the supply is cheap to build, and there's a lot of land to build up on. So the supply can increase significantly when people smell the money. And that's always a risk for the rents, because then you have more supply, it means the rents might go down or, change. So for me, that's more of a concern, of a structural concern I have about logistics, and something that one should keep an eye.
Okay, thank you.
Hi, Thanas. Thank you for going through all this. I just have a question. With all this market situation at the moment, and like inflation going up, interest going up, but then also on the other side, construction costs are going up and supply chain issues. So do you think that the market in Europe can absorb and the developers can pass on these to the sales, or will see difficulties on selling developments. And like recently, we see developments being sold here at a loss, and you would avoid, for example, investing in developments at the moment.
Developments are a very tricky business to be at now, unless you have locked your contracts with your contractor and your contractor has locked their contracts with the subcontractors and the providers of the raw materials like iron, which has gone 3 times up, cement, aluminum. They're going to be screwed and come back to you. Even if you have a turnkey contract, they will come back to you and ask for an increase because there is a force majeure, as they call it, or because they're just going to go bankrupt if you don't help them out. So what happened in some cases that we have seen is that the market moved almost in parallel with the increase in the costs. So we had the case we have seen where the costs went, I would say 30% up, but the rents went also, call it 20% up. So they covered a lot of the ground. And at the same time, for some very strange reason, probably because the interest rates are still very low or negative, the yields compressed a bit. So a building that actually cost 30% more to build, 35% more to build, ended up making more money for the developer because the rents increased and the yield dropped. And that was more, the difference was more than the increase of the cost. I think that's, though, I can't say that this will be an example applicable everywhere, because that was a market that was undersupplied here in Athens. It could very well be the case that if you are somewhere else in Europe, the tenants will just decide not to move, because a lot of these new developments are not new demand. This is also relocation to a better building with lower service charges, so that the tenant eventually will save up on their housing costs. If they feel that the market is wobbly and they are a retail business, for example, they might hold back on the move. They might not expand. So that means that the rents will not keep moving up. The pressure from the rents might be released. So the developer might not be able to compensate for the increase in the costs. They will have to basically eat it up and eventually eat up all their developer profit. And that's why you're absolutely right. I won't be surprised if certain developments actually are sold at a loss. I think this time in this part of the cycle, thankfully, a lot of these developers did not take too much leverage, as was the case before. So at least they don't have the extra pressure of the interest, which back in 2008 and 2009 was 6%, not 0% that it is today, the Euribor and the LIBOR. So at least they don't have this pressure on top. They only have the market pressure and the fact that they might end up with a building that they're completing, but it's not fully let. If they have cash in their coffers, they might be able to sit it out and wait it out basically. If not, and they're in huge kind of urgency to actually liquidate that and sell it to go to the next one because they have other commitments, then they might need to sell at a loss. Why? Because maybe they will sell something with a vacancy, and even if the market, let's say it's at 5% yield, you cannot sell a vacant area for the same yield, or you would have to deduct, even if you sell it for the same yield, you would have to deduct 1, 2, or even 3 years worth of rents for the next buyer to take it and take the risk for this thing remaining vacant for these 2-3 years.
It's an interesting one because the markets have been so driven by low interest rates for so long. If you take the residential market, and I'll just look at London for a second, so much of London is driven by the fact that you can buy housing, although at an incredibly high price, with a large chunk of debt at almost nothing. So it is so much cheaper to own property than to rent property in a place like London. But I just posted the link there. The Fed just raised the US interest rates by 0.5% an hour ago. And as we're going to see, the forecast is that we're going to get, I think it was 7 interest rate rises this year out of the Fed in the US. UK is already a bit ahead of that. But I think a lot of spending that happens in the economy comes out of people's increase in house value. So they remortgage, or they move and sell and take a bit of profit, and they use that to fund consumption. And so if consumption is going to fall, because we've had insane spending on consumption through coronavirus, it's just been so counterintuitive, and that feeds through into logistics, feeds through into like all of your tech companies. So all of the REITs that own server centers, data centers, were doing really well. All of the REITs that were owning logistics were doing really, really well. And all of a sudden you saw in the space of, I think like a day, Amazon's share price fell by 14% because they missed earnings. Netflix fell by 40% in an hour. Yes. You know, it's a wild situation. That wasn't such a concern. You saw these movements happening during coronavirus, but interest rates have stayed low and stayed low and stayed low. And just as Paul was saying a second ago, the party is kind of over on that one. The lights are being switched off. And I think that we're in this situation where it's going to start in the resi space. I think the resi developers are about to eat a lot of shit. And you just saw, so in China, the Chinese government has a serious situation. I think it's Evergrande has 300 billion or 200 billion of debt, which is basically backed by the Chinese government. And Evergrande is going bust. They can't pay their interest. So the Chinese government is demanding, in a nice way, like really requiring Chinese developers overseas to sell off their schemes and pay down any debt they've got in China. And so you just saw 2 schemes get sold in Nine Elms in London, making hundreds of millions of pound loss month after month after month. They're just selling schemes off cheap to get out of these developments. And so there's this weird global thing going on, and then add in this kind of turbulence that's coming out of this terrible situation in Ukraine, and you don't have Russian money pouring into housing and assets now, which was really part of the London bubble. So it's like, I genuinely think we've got so many dominoes that are going to collapse on top of each other, that actually it's a bit of a heyday for certain investors. On the flip side, you just want to get leveraged through the wazoo, because if inflation's going up and you're a levered real estate investor, you're making money, but just try not to be a developer.
Yes, development is gonna be a struggle. Look, guys, it's kind of, yeah, it seems that we're going through, the cycle seems to start going downwards now. And we went through a period of 10 years almost of very low interest rates or even negative interest rates. That was, at least as far as I know, that was not done before. And it's the first time that we're so many, if you will, huge quantitative easing weapons that were used by the governments. I mean, printing so much money, again, I think is unprecedented. And when the coronavirus hit, everyone thought, okay, the whole world is going bust, basically. And what happened? The governments pressed print button and everyone was saved. We're reaching a point where this print money has somehow to start going back home. And that's why we might start seeing some changes. So everyone needs to be very alert. Yes, Chad.
I've actually had a similar conversation with a lecturer in real estate finance, and it almost seems as though the quantitative easing that happened in the last, I don't know, 4 or 6 quarters or so is almost counterintuitive in the sense that they've delayed essentially what is the inevitable. Because now, when they push all this liquidity in the market, you have cap rates, compressing significantly. But now with all these adjustments, you just mentioned it's going to be about 7 adjustments in the interest rates, it almost seems as though a lot of the investors that went in, and in my opinion, a lot of them probably overpaid for properties because the adjustments or the compressions in the cap rates were almost artificial. There was no rhyme or reason behind it. It almost seems as though like a lot of investors are going to end up holding a very raw deal at the end of the day, because what they've projected when they acquire the property, they're probably going to be looking at maybe 300 basis points above what they may have initially thought they would be able to exit at.
Yeah, and an example that I keep mentioning because it was so amazing when I first saw it was back in 2007. A kind of a private equity fund acquired the Gherkin in London, in the city of London, this beautiful building by Foster Partners. They bought it for 4.25% yield. At that time, the interest rates for a senior loan, the base rate without the margin, was 6%. So the borrowing cost was higher than the yield that you're buying it. On top of that, they were so certain, and before I say why they did it, on top of that, they added a mezzanine piece. So they added another piece of leverage that was, I think, was 8 or 12% costs. Why did they do that? Because Swiss Re, the reassurance company, which was taking half almost of the Gherkin, was considered to be significantly under-rented. And it was very close to the upwards-only rent review time that this lease contract had. So in their mind, they were going to buy it for 425 immediately, or as soon as they can, go back to market with the upwards-only rent review. For me, that's a huge bet. And sell it again for maybe 425 or 5% or whatever, and make the profit. And the profit would probably have to be that big and that large that it will have to cover for the very expensive debt which was on top of the yield they were taking. Financial crisis came, rents were halted. Actually, they did not grow, they dropped, and they were left with a building they could not do anything with. And obviously they had to basically sell it, I think, at the loss. I don't know what happened eventually. They came to us to buy it at some point, then we did not agree on the price and so on. But the point being that when you underwrite a building based on rental growth, you are in a very dangerous path. And you might be bold and smart and do an amazing deal. And if you achieve it, everyone will basically high five you and you get a promotion. But I think it's something that I try to avoid. And as a CIO of a REIT, when we do a development or when we buy a building, we try to be as conservative as possible and almost use current market rents to make sure that if we need to do a reletting, it will still work. I will not say that, oh yeah, in 12 months or in 24 months, lease is expiring. Don't worry, rents are gonna be 15% up. It's okay, we're gonna crash it. For me, that's something, because I kind of started in the 2008 kind of era. Phil and I actually started by working like crazy to put down fires, rather than working like crazy to do new deals and get amazing money. So I started on the wrong way. I started on seeing what can go wrong and trying not to repeat it. Maybe too much at some point. So I'm a more conservative investor by nature, but that's why I'm in a REIT and I'm not in a super opportunistic fund, perhaps. I can do opportunistic deals. I can structure them like crazy. I can understand them all the way. I might not do as bold of bets as other people might do, because that's the way I saw things going wrong. So a lot of things that we see now, everyone who has started a development, assuming that rents will keep going up because of all these amazing things that were happening, I think we'll wake up and smell very bad coffee and not like what they see. The tenants are becoming more cautious, and unless you give them a very strong reason to come to you, like for example, every building we are creating now in Greece, it is a green certified building. That means that you might have even 30 to 40% lower service charges, lower cost of energy, for example, and smart ways of using rainwater and so on, that eventually will reduce your effective cost of living. Because even if the rent remains the same, your service charges are not anymore 5 or 4 euros. Now they're 2.5 euros per square meter. So immediately you save 1.5 euro per square meter. So it's like you reduce your rent. And these are smart ways that developers and owners can do to keep the demand for their assets. You have to work for them. And just to close it, I always prefer business plans where more things are in my hand rather than out of my hand. It's in my hand to do a nice redevelopment. It's in my hand to design a beautiful building. It's in my hand to make a building more energy efficient. I can make a decision, I can pay the money and do it. My risk is that it might cost me more to do it because things have changed, but at least I know I can do it, rather than just hoping that the rent will go up. This is just something I cannot control. So overall, if you can find in any given investment things that you can really affect, even in a residential building, you are a small investor and you just want to flip a residential asset, don't buy it because you think that in 10 months you can sell it at a profit. If you feel that you can buy it at a very cheap price because the seller is in need, the seller did not realize that they were selling very cheap, okay, great. Maybe you can flip it and make money immediately. But if it's an older apartment where you know, look, I'm going to change the kitchen, I'm going to refurbish the bathroom, I'm going to put very nice tiles. It's not going to cost me much, but it's going to look much. Then I can sell it for a premium that is twice the money I spent to fix it. That's something you can relatively easy control. And this, for me, this is an approach I prefer because it gives me a little bit more feeling of control, although in the world we live in, there's not much control sometimes.
Very
Thank
nice.
you.
Sorry, anyone else? Anyone else got any questions? We're just coming up on time. So if anyone had anything to throw out there, please by all means go ahead, but we're going to wrap up otherwise.
A quick question. I don't know if it's straightforward to answer, but so once you add the value to a property, how do you decide whether you dispose it or keep it? Or does that just depend on the strategy of the REIT itself?
It depends on the strategy, Thomas. So when you are REIT, most of the times you buy something to keep it. As I mentioned at the beginning of the call, our very simple purpose in life is to own buildings, receive as much rent as we can from them, and pay it as dividend to our investors. That's it. Very simple. So in our business plans, just for argument's sake, we just do a 10-year business plan. It's not that we're planning to sell the asset in 10 years, but you need to define a period of time to calculate an IRR. So we take 10 years as a period of time. And that's it. If you are a more opportunistic investor or a value-add investor, you would probably take the life of the time it will take you to turn around the investment is what you would use in your business plan. So a hedge fund or a private equity real estate fund, usually they raise the money, they have 2 or 3 years to invest that money, and then they have to return that money after 7 years, 6, 7, 8 years, somewhere around there, which means that they have around 5 years for the business plan, to execute the business plan, 5 to 6 years. So they would enter in transactions that are anywhere between 4 and 6 years, more or less, of a life. Like buy a building, get permitting, fix it, rent it, sell it. Or if it's residential, build it, sell it, something like that. A developer, again, buy the land plot, 6 months for permitting, and 1.5 years for, let's say, to build a shed, and then rent it out, sell it. So 3 years perhaps of time. And that's the nature of these people. So this is what would define your time, your time horizon.
Thanks, Thanasis.
Thank you for the questions.
Good. Well, look, everybody, thank you very much for joining us. Thanks for your questions. Just as a final plug, a lot of the stuff that we talk about today, particularly around the cash flow modeling side, and also a lot about the investment side, we cover in detail in our Capital Markets Accelerator program. And want to thank a lot of people on here, Antonia, Ed, Diane, and a bunch of others, Carol, for being part of that program. If you're interested, just shoot us a note. Just shoot me an email, phil@ascension-training.com, or reply to any of our emails that you're getting from us if you're interested to learn a bit more about that. But otherwise, wishing you guys a very good evening. Thanasis, it's midnight for you, I think.
11.
It's 11. So thank you for staying up late and going through it. And thanks to everybody for your questions. Time to go and have the rest of our evenings.
Thanks, guys.
Thanks, Thanasis. Much appreciated.
Thank you.
Everything you do.
Thanks, everybody.
Was
Take
a
care.
pleasure.
Bye-bye.
Thanks, Phil.
Thanks a lot. If Adam's top Oli.
Παρακαλώ. Thank you, Lucas. Good night.